Big news today. China's yuan just hit a 14-month high against the US dollar, sending shockwaves through the financial world and grabbing the attention of investors everywhere. The yuan has surged to 7.0498 per dollar, a level we haven't seen in well over a year, and traders are scrambling to adjust their strategies. This is the strongest the yuan's been since October 2024, and it's shaking up the global economy. Currency markets are buzzing, and the ripple effects are being felt from Asia to Wall Street. When a major currency like China's moves this much, it's a sign that global power dynamics are shifting. Central banks, multinational corporations, and governments are all watching closely, recalibrating their next moves. The yuan's rise means the dollar is falling in comparison, impacting everything from international trade deals to the price of your next smartphone or laptop. Even the cost of everyday goods could be affected as supply chains adjust. American companies selling in China, like Apple and Starbucks, are directly affected, as their products become more expensive for Chinese consumers. This could influence their sales numbers and even their global strategies. At the same time, retailers and manufacturers who import goods from China are feeling the pinch, as a stronger yuan means higher costs for everything from electronics to clothing. A stronger yuan gives Chinese consumers more buying power, making it easier for them to purchase imported goods, travel abroad, or invest in foreign assets. But there's a flip side. Chinese exports become more expensive for the rest of the world, which could slow down demand for products made in China and shift the balance of global trade. This is a high-stakes financial chess game, with every move watched by economists and policymakers. The first move has just been made, but the next ones could reshape the global economy for years to come. Why should you care? Because in today's interconnected world, what happens in Beijing can impact your wallet in New York, London, or Tokyo. Exchange rates affect everything from your investments to the price of imported goods at your local store. The bottom line, a stronger yuan is a double-edged sword for global trade and investment. It brings opportunities for some, but challenges for others, and everyone from CEOs to everyday shoppers will feel the effects. To really understand what's driving this surge, we need to look at China's economic policies, global demand, and the shifting tides of international finance. Only then can we predict where the money's headed next. Don't blink, this is just the beginning. The world is watching, and the next chapter in this financial drama is about to unfold. Booyah! The yuan's strength isn't happening in a vacuum. The US dollar is weakening. The Federal Reserve has cut interest rates 3 times, dropping the federal funds rate to 3.75%. Lower rates make holding dollars less attractive, so global investors move their money elsewhere. Even though Fed Chair Powell tried to sound tough, the market isn't convinced the cuts will stop soon. This uncertainty is dragging the dollar down. A weaker dollar makes US exports cheaper but imports more expensive, affecting everything from your next vacation to the price of imported goods. The dollar's slide is a key part of this story, setting up big moves across all markets. It's basic economics. Less yield, less demand for the dollar. The Fed's actions are rippling through the global system. Don't take your eye off the buck. The next chapter is just beginning. There's another force at play, one that's often overlooked by casual market watchers, but it's a crucial driver behind the yuan's recent surge. It's the seasonal demand from China's exporters, a phenomenon that quietly but powerfully shapes currency flows every year. Each year, as Chinese companies ship billions of dollars worth of goods to customers around the globe, they're paid in foreign currencies, most often in US dollars. But to keep their factories running and fulfill obligations at home, they need yuan to pay their workers, suppliers, and cover year-end expenses. As the calendar approaches year-end, these companies scramble to convert their hard-earned dollars into yuan, creating a predictable and powerful surge in demand for the Chinese currency. This annual rush, known as seasonal demand, consistently puts upward pressure on the yuan, especially in November and December, as companies prepare for bonuses, payroll, and settle accounts before the new year. This year, the effect is even more pronounced, thanks to an already weak US dollar. The combination amplifies the yuan's strength, making the seasonal effect impossible to ignore. The result? A perfect storm is brewing, one where both seasonal business needs and global currency trends align to drive the yuan higher than usual. This isn't just about traders speculating on screens, it's about real businesses, with real obligations needing cash on hand for payroll, bonuses, and year-end settlements. Their actions ripple through the entire financial system. When genuine, real-world demand collides with broader macroeconomic trends, you get explosive moves like the ones we're seeing today. Moves that can catch even seasoned investors off guard. Understanding this seasonal flow isn't just a detail. It's the key to unlocking why the yuan is flexing its muscles right now, and why it may continue to do so in the coming weeks. It's a powerful, fundamental force, one that's rooted in the real economy, not just in financial speculation. The timing couldn't be more critical. As the year draws to a close, these flows reach their peak, shaping the currency markets in ways that are both predictable and dramatic. This is how the real economy shapes the markets. If you want to understand the yuan's strength, don't miss this seasonal story. It's unfolding right now. You'd think China would celebrate a strong yuan, but it's not that simple. A rapidly rising yuan makes Chinese exports more expensive, threatening their competitiveness. To slow things down, the People's Bank of China, PBOC, uses its daily fixing, setting an official midpoint for the currency. Today, the PBOC set a weaker-than-expected fixing, signaling they want to cool the yuan's rise. It's a subtle way to manage the ascent without causing chaos. China wants a respected currency, but not at the cost of export jobs. The PBOC is walking a tightrope, allowing some strength but keeping control. This intervention is crucial to the story. Stability is the goal. The global currency drama isn't just about the US and China. Japan is stepping in too. While the Fed cuts rates, the Bank of Japan is preparing to hike for the first time in years. A 0.25% rate hike would make yen more attractive, ending an era of ultra-cheap borrowing. This shift threatens the famous yen carry trade, where investors borrow yen cheaply to invest elsewhere. If Japan hikes, it could pull liquidity out of global markets fast. The Fed is adding liquidity, but Japan may start taking it away. This clash of central bank policies is creating tension and uncertainty. The world's biggest economies are moving in opposite directions. That's why markets are on edge. Watch this space. The yen carry trade is a ticking time bomb for global markets. In August 2024, fears of an unwind triggered a violent sell-off. Bitcoin plunged 15% in a day. Here's how it works. Investors borrow cheap yen, convert it to dollars, and invest in higher-yielding assets. If Japan raises rates, borrowing yen gets expensive and the yen strengthens. Suddenly, those trades turn unprofitable, forcing investors to sell assets, stocks, bonds, crypto, to pay back yen loans. This mass selling is called an unwind, and it can crash markets fast. The ghost of last August is back as the BOJ meeting approaches. A rate hike could trigger another, even bigger, carry trade unwind. Risk assets everywhere are vulnerable. The stakes are high for everyone in the market. Stay alert, this could be the next big shock. Don't get caught off guard. So, what about Bitcoin? It's caught between two powerful forces. A weaker dollar usually boosts Bitcoin, as it takes more dollars to buy one BTC, classic inflation hedge. Investors flock to Bitcoin when the Fed cuts rates and the dollar drops. But if the yen carry trade unwinds, liquidity drains from the market. In a crisis, investors sell risk assets like Bitcoin to cover their yen loans. When liquidity dries up, everything sells off together, no matter the narrative. Bitcoin is on the brink, pulled between bullish dollar weakness and bearish liquidity risk. Which force wins? That's the multi-trillion-dollar question. The answer will shape the next chapter for crypto. Stay tuned. Volatility is coming. The tug-of-war is real. Another warning sign for crypto: spot Bitcoin ETF inflows are drying up. After a frenzy in November, institutional money has slowed to a trickle. Last Friday, net inflows were just $49 million, down sharply from the peak. Only BlackRock's fund saw real buying. Others had little or even outflows. Big investors are pausing, worried about a potential market shock from Japan. They're risk managers, not crypto idealists, and they're waiting to see what happens next. This slowdown in ETF flows is a red flag for Bitcoin's price stability. If the yen carry trade unwinds, who will buy the dip? The ETF hype is over. Now comes the real test. Institutional conviction is about to be challenged. So, what does all this mean for you? Whether you're an investor, a business owner, or just someone trying to make sense of your monthly budget, these shifts in the global financial landscape will touch your life in more ways than you might expect. We're in a period of global uncertainty and transition. Old rules are out, new risks are in. The financial playbook is being rewritten in real time, and volatility is the new normal. A stronger yuan and weaker dollar mean imported goods from China could get pricier. Everyday items, from electronics to clothing, may see higher price tags, impacting your wallet at the checkout counter. If you work for an exporter, a weaker dollar could help your company's bottom line, making your products more competitive abroad. But if you're planning a vacation overseas, be prepared. Your travel budget won't stretch as far as it used to. For investors, caution is key. Liquidity is no longer a one-way street. Quick profits are harder to come by, and sudden market swings can catch even seasoned pros off guard. The yen carry trade unwind is a real threat to stocks and crypto. If leveraged bets start to unravel, we could see sharp corrections across global markets, affecting everything from your retirement account to your favorite tech stocks. Diversification matters more than ever. Spreading your investments across different assets and regions can help cushion the blow from sudden shocks and unexpected downturns. Watch the Bank of Japan's meeting. It could be the year's biggest market event. Their decisions may ripple through currencies, stocks, and even the price of goods in your local store. For businesses, now is the time to reassess your currency risk and supply chains. A single policy change or currency swing could disrupt operations or squeeze profit margins overnight. The yuan surge is a symptom of a global system in flux. It's a signal that the balance of economic power is shifting, and everyone, from Wall Street to Main Street, needs to pay attention. Stay informed, stay nimble, and don't get complacent. The headlines may change daily, but your ability to adapt is your greatest asset. There's always a bull market somewhere, but you have to do your homework. Research, ask questions, and don't be afraid to seek expert advice as the landscape evolves. The next move is yours. In a world of uncertainty, being proactive and informed is the best strategy for protecting and growing your money.